Welcome to our GWS Weekly Podcast with the Gatewood Wealth Solutions Investment Committee and our guest this week, Professor from Wharton, author of the book Stocks for the Long Run, Jeremy Siegel. Professor, thanks for joining us.
Chris, I'm happy to be here.
I figured we could start with inflation. With the FOMC just closed out their meeting a couple hours ago. Right now it is 3 p.m. Central on Wednesday. I saw you earlier on CNBC discussing what you thought the Fed was going to do today. You thought they were going to be a little hawkish and that they needed to be. What did you see?
Yeah, well, I saw the dots move forward, in which, as I said, the market was going to react to that, and it certainly did. I mean, he remains quite dovish, extremely dovish. I had mentioned months ago that he's the most dovish central banker I've ever seen. And he's explaining away all this inflation as purely temporary. I do not think it's temporary. I think we're going to see persistent inflation for quite a few months, and well into the next year. But basically, the only way one of us will be proven right is through time. As we get the data and we see the inflation, we will see whether it continues or not. I think it will continue. In fact, I wouldn't be surprised if it even accelerated from what the readings we now have.
It's interesting. In your book, you mentioned that inflation is always a monetary phenomena. And I can't remember if you were directly quoting Friedman, but obviously that jumped in my mind. And then talking about a very dovish Fed, Chairman Powell has said that really there's no relationship between these monetary aggregates regarding inflation. What say you on that claim?
Well, there's a very loose relationship. But to say no is really totally denying the long run data. In particular, the money supply that I look at is the M2 money supply. And I see it 30% above the pre-pandemic level. And my back of the envelope calculations, given the growth that we're going to have and all that, means that over the next several years, we're going to have a cumulative 20% inflation, approximately. I don't know how it's going to be divided, whether it's going to be, 5554 or 773 or 1052, whatever it is. It's going to be coming, and we're just beginning in the crest of this inflation. So no, it's not a good predictor month out of month what it's going to be, but it's a very good predictor over several years. Particularly when you look at these broad supply-based numbers. And particularly, we are in an area of stable or rising interest rates. When you have a falling interest rate, you can have money supply increases that are not inflationary. When you have stable or rising interest rates, it's much more likely that money supply increases will, in fact, be inflationary.
So you said historically developed economies that have this high 12+% inflation have always been able to squeeze the money supply to get out of it and stop it. With where we're going from here, with government debt approaching 30 trillion, will the Fed be able to squeeze the money supply this time?
Well, it can stop its increase. So it had a big increase in March and April and May of last year. But since then, it's just continuing to go up at 12.5% a year. Now, that's excessive. It's got to stop that growth. It's not going to bring money back down to pre-pandemic levels, but it's got to slow it back down to around 5% a year. That's what we had for 35 years before the pandemic, and that was consistent with about 5% nominal GDP growth. As really the quantity theory, Milton Friedman would be predicting. One should mention, by the way, that during the inflationary 70s and early 80s, the money supply increase was growing at 9.5% a year, and we were having, often double-digit inflation. So we're at 12.5 now. Now, I'm not predicting double-digit because I think we're going to get it back down, but this is clearly, to me, excessive money creation. And I feel that this pulse of inflation is going to be pushing over the next 12 to 18 months through the economy.
So we're in a complete agreement with you with stocks for the long term, but we're practitioners and we have to deal with the retail client often. It's not necessarily just behavior aspects. They often own a business and they don't know whenever they may need to access their capital. And oftentimes when that comes around, it's whenever stocks are depressed. What would you say to us, or what would you say to our clients who may need cash in an unknown time period? And how would you hedge some of that risk that they have whenever the short term doesn't equal the long term?
Well, that's always the case. Now, of course, on marginable stock, which is basically all stocks traded on the exchange, you have 50% ability to borrow off of it at very favorable rates for a long period of time. And then, of course, you have your own personal businesses and homes that one could borrow off of also. The question is your fluctuations in cash and how much you would need. But traded stocks are very liquid. Mm-hmm. Now, bear markets, generally the severe ones are down 40 to 50%. One always has to be prepared for that sort of a drawdown eventually. Normally they'll snap right back and then move to new all-time highs. But again, if it's down 50 and you can only borrow 50, that's only like them borrowing 25% of your portfolio at that particular juncture. So at that particular point, that's obviously where the cash reserves and bond reserves come into play.
So if you were going to construct a portfolio that really is looking out the next 30 years, so we get past this inflation, so I don't think gold would necessarily be in your 30-year portfolio.
Well, don't forget GLD. Those are marginable too. And gold is certainly very, very liquid also. Well, what's not liquid is private equity, venture capital, and some land. And obviously your home can't be sold tomorrow, although you can get a mortgage under, on it. That takes time also. But stocks are the most instantly liquidable of all of those particular assets.
Yeah, to follow up with Aaron's question, it is difficult to have clients own a lot of stocks when volatility is high. As many of them cannot tolerate that kind of high volatility and tend to sell stocks at the wrong time. Equity volatility has been trending lower for really the last 30, 40 years. You have talked about it in some of the lectures you did. Do you see that kind of low volatility persist for not at least 5 to 10 years?
Well, Tal, you say that, but I'm not completely in agreement with that. Some of our worst bear markets have been recently. We basically had 2 bear markets in the last 15 years, and both of them were pretty dramatic drawdowns. The financial crisis was nearly 50%. The financial crisis on nominal terms, not on real terms, was the biggest drawdown since the Great Depression of the 30s in terms of stock values. The pandemic drawdown was 35% or so. That's pretty severe. We've had some big drawdowns. Now, you are right in the sense that between these big drawdowns, there isn't a lot of volatility. That's where you see it off the VIX. You see 8, 9, 10 on those VIXs, on those shorter term volatilities. But the clients are more worried about the bear market drawdowns. And they've been pretty sizable, actually, in recent years. They've been very far apart. So you've had long kind of bull periods and then a big drawdown. So it depends on where you benchmark it from. We have had, that's why I say, you've got to be prepared for a 50% drawdown. If you're prepared for that, then you weather the storm, you don't sell, you don't panic, and then you enjoy the bounce back.
Yeah. I think that's definitely something we're trying to convince our clients to do, because if we have, let's say, 10, 15% correction, every 6 months, right? That was the time where, and the clients couldn't take it, if you have 2 or 3 times. That's sometimes, they just hate it. And, when we have like a 30%, drawdown once in 10 years, we are able to convince them to, to do the right thing, so that's where I'm coming from. So yeah, I mean, definitely. I mean,
every 10 years they'll take your advice, but if every year they get
hey,
a little get tired of it.
Especially, when someone.
Well, I often said one of the biggest jobs of advisor is holding hands.
Yes, very much so.
Yeah, that's a hard part.
And the better you hold the hands, the better advisor you are. And because the equity gains are always long term, you've got to be able to get through a whole series of short runs to realize and enjoy these the long run returns.
Right. Yeah. Other than inflation risks, what are some of the risks you see in the market in the next 5 to 10 years? Any exciting opportunities you see?
Well, I mean, there's always going to be risks in the equity markets. I mean, I'd be genius if I could foresee them, because they usually come out of the blue. But I do believe, for instance, as time goes on, that cyber risk is one that we have to really take seriously as a country, and that's a risk I see probably more than a shooting war as a potential cause of decline on equities. You're going to have normal business cycles. That's part of market capitalism. But I think that is one thing. I mean, long term, we have climate challenges, but that's a long grinding situation. That's not something that, we'll wake up tomorrow and, it's going to drop earnings 30%. So that's something we have to work towards, but it's not something that's going to be a sudden risk like cybersecurity.
So one of the things that we talk about is there was this thing called passive investing where people would buy ETFs. I think you've heard of it before. But really now we're looking at it and no one's really building new ETFs for passive investing. All they are really just low cost options to get a hold of stocks. There's all kinds of factor weightings and other things. What's wrong about the thinking of passive market cap weightings whenever you're?
Well, that's what we at Wisdom Tree, of course, specialized in. And, I mean, that universe is pretty well saturated, I would say. I mean, first came cap weighting, and then we went to fundamentally weighting. We've done a lot of those. Others have moved into that direction also. But I think style weighting is now what is in vogue. I mean, and we have a lot of those too that we think are important, like the cybersecurity, the cloud, and others. So I mean, now what we're doing is there's many more styles, that you can go in, and that I think is where you see the push of the ETFs now.
Do you think the market is, despite maybe some factor premiums, is it reasonably efficient? And when I say reasonably efficient, is there's some option, the ability to make some active return, given the amount of maybe inefficiency that has been driven into the price with so many stocks not being actively traded by the big.
Well, there are still a lot of inefficiencies in the market. I mean, I've often asked the question: is there too much indexing? No. There will be too much indexing when active managers after their fees beat the market, and by and large they still don't. So that means that there's not too much passive. If everyone was passive, then active managers would have a field day because everything would be mispriced. They'd make a lot of money. So things are, the markets are reasonably efficient. It's not easy to find inefficiencies. But we at Vanguard tried to find them in a very consistent, diversified, and systematic way through our fundamentally weighted indexes. That's how we are trying to slowly accrue the inefficiencies that we see in the market.
So I know you're getting a lot of headlines about inflation, and you're on TV talking about that. Something that was getting a lot of attention before was just the GameStop and the Wall Street bets. And we were looking at just the amount of GameStop that was in retail ETFs that would never trade because they're not going to make a change based on the valuations. And we were wondering while this was going through, is there enough float really for that GameStop, or is it allowing more manipulation than otherwise would be, where the fund manager would have sold it and actually increased the amount of stock available?
You know, the way I think about these meme stocks in general, Aaron, is that they're very active. They catch the headlines. The talking heads love to talk about them. But the truth is their market value compared to the market value of all the other securities is totally trivial.
Mm-hmm.
You know, if you're a gambler, you might be interested in these. If you're an investor, I'm not interested in these. You know, so I think you have to view it as such. And you know, what kind of regulation you do or don't want, and information and disclosures is obviously something that needs to be discussed. But these, at this particular point, I don't think these meme stocks are central, or should be, or will be central to the market.
No, they often are central to the headlines, that's for sure.
Yeah, they're central to the headlines, but to the average investor, you know, when you have $15 trillion of stock in the U.S. alone, 20 trillion. I mean, and then you see, you know, AMC or GameStop with a few hundred, you know, couple hundred billion. You're a tiny fraction here.
Another thing that we discussed in the investment committee is why isn't that there's more people shorting the funds? And
well, there are. It's just that it's really risky.
It is, and we were wondering if the current monetary policy is making it really just too risky.
No, I don't think so. I you know, a lot of people say because of zero interest rates, but I don't really think it's that. I mean, you know, the interest rate 1 or 2% a year, or down 2 or 3, do you think that would change? Not really. I mean, the borrowing costs are still trivial compared to, you know, the position that you're taking. Now, I think it's a kind of a phenomenon. Hey, you know, we can stick it to these Wall Street guys. We have a lot of power in and of ourselves, and the ones early on are making money. There will be a lot holding the bag and losing money at the end, to be sure. And those hedge funds that grit their teeth and hold on are going to be winners. But in the meantime, it's painful.
You know, one of the other things that seems to be getting a lot of headlines is just this ESG investing.
Yeah.
Is this another fad? And as a follow-up question,
no, this is not a fad. I think I don't think it's a fad. Now, you know, you know, we say ESG and we put them all into one group. They're not really one group. Mm-hmm. I mean, there's the E, which is the environmental, which is really you know, very substantive, and which a lot of people talk about and care about. The G, the S, you know, and G, which is social and governance, are much more loosely defined. And a lot of the governments are actually things that all of us would advocate for corporations in terms of the type of transparency and disclosures and audits and one class of stocks and separating CEOs from chairman. I mean, I can go on and on. We'd all advocate it. On a social thing, it has to do with diversity, some social involvement in the community, et cetera, and so on. I mean, there's always been some of that one way or the other, and we could debate whether that's good or bad for the corporations and et cetera. But as a group, I think ESG is going to be here to stay for many years in advance. Will they outperform? That's another question. If you get in early enough, and people are still moving into ESG mode, they will outperform. Once people get to the level they want on ESG, then they may become overpriced and underperform after that.
one of the things that we have noticed, and we've been overweight technology stocks for quite some time, is a lot of the companies that fall under that ESG mandate is often a technology company. Is some of that outperformance? I guess some of it would have to be, but do you think a lot of that?
Well, technology stocks are wonderful on the E part, particularly because they're not big fossil fuel users and et cetera and so on. So they do really pretty well on that. On the governance and the social part, a lot of them do well on the social part. That's part of their ethos. On the governance, it's very mixed. There's a lot of ones that have dual classes of shares and other ways to entrench management that are not particularly good governance, but some do.
Yeah, my question about that in terms of like at what point is the things start getting priced in? Like you said, will it outperform or?
Well, they already do. I'm not. Yeah, I mean, they're going to be priced in. They're going to be overpriced in eventually. Right. I mean,
and that's
we all know that any trend gets overpriced at the end. When that is, I still think ESG momentum is there on a positive one. And if it's very, very tricky because different companies rank ESG very, very differently. But I think the popularity of ESG funds is going to go up, and so that there will be money searching out highly rated ESG firms. And in that particular case, you would get to an outperformance.
I had the same question for what we were talking about earlier with monetary policy and pricing in a taper of asset purchases, which it seems to be everyone's talking about and everyone thinks it's going to happen at some point this fall. Is that going to be priced in, or is there?
Yeah, going to be I mean that we all know it's going to happen. But we all hope that day is further in the future, right? I mean, that we all know that the rates are going to go. They're going to start tapering. I mean, and honestly, they should start tapering right now. There's zero need to buy $120 billion a month, given the economy that we have. It's really nonsense. But nonetheless, it doesn't really do a lot of harm to the economy because all of it's just really going into excess reserves of the banking system. It's not really lent out right now. And so it's just a matter of where is the cash, and it's so it's excess reserves of the banking system. But that's still that's like kindling that can be used if the banking system starts lending again. They have to deal with that at some particular juncture into the future. Well, again, going back to the very beginning, I believe that inflation data is going to continue to run hot, and as a result, they're going to keep on moving forward at a date, and definitely will start tapering. In fact, I would not be surprised in the next 3 months for them to announce a taper.
So,
in the next 3 months, and then I wouldn't be surprised, therefore, an increase in rates that occur even maybe late this year, if not early next year.
So stocks for the long run, right? But you make good points about why in the short run it's noisy. Short run with inflation. Are you making any predictions this time with inflation?
Well, one thing has to, what I often emphasize is that stocks are real assets.
Mm-hmm.
People think, the only real assets are gold and property or something like that. No, stocks are claims on capital, plant, equipment, copyrights, intellectual property, trademarks. All these things are real. Now that's in contrast to a strict bond, which only promises you dollars, and they could be very depreciated dollars as time. But when you buy a stock, you're buying the company and all its real assets. In fact, the better companies in inflationary times are those that are levered, especially to long-term debt where they fixed in low rates and therefore can pay off in depreciated dollars. So don't put stocks in any sort of same bucket as people say, well, financial assets, as if they don't react to inflation. They're just the financial claims on real assets. So I'm not worried really about inflation. Now, it is true that when the Fed finally clamps down on it, there's a ripple, and there may be a mild recession down the road if they start moving up rates to slow that inflation down. I wouldn't be surprised if that would happen, and you will see reaction in stocks at that particular juncture.
Yeah, I have a question about the 10-year Treasury. I mean, why is it so low? It just dropped below 150 again lately, and why? Yeah, at this point, you would think 10-year Treasury would be at least 2%, 2.15 or something like that.
Yeah.
And the Fed has been buying, of course, but it looks like some other market force is moving in to buy that Treasury bond. So
Yeah,
what's
there's
your
a
take on
lot
that?
of reasons. So there's a lot of buyers on. First of all, we're in a big secular decline of interest rates that still continues from 20 years ago. Real interest rates are going down, and this has to do with demographics, world growth, aging of the population, risk aversion. We can go on and on. So you have this trend downward on real rates. On top of that, you have to add the inflation rate onto that, and that would put pressure on that nominal bond and not on the real bond. But particularly more recently, you've had some good action in that long bond because, first of all, Biden's infrastructure bill is in trouble. Much less likely now than it was just 3 weeks ago. That was $2 trillion of expending. So the fact that the market knows that is now a less likely situation brings buying into bonds. Bonds are also being bought by foreigners, where the rates are much higher. Even after you correct for interest rate parity between the currencies, you find an advantage on the dollar. You're also finding tremendous bond buying by corporations that are defeasing their liabilities on their pension funds, especially as they become fully funded in a good stock market situation. That brings a big source of demand. And then you have a big underlying demand on bond because it's viewed as a negative beta asset. And what I mean by that is that if the Dow's down 2,000 points, your Treasury bonds are going to be up, and that's good. I mean, people like that, and they're willing to pay for it, and as a result of paying a lot, so that your yield is low. So all those features are coming to play that put downward pressure on the 10-year bond. That being said, I do think the rates are going up from this particular point as the reality of the tapering and then the reality of the actual rate hikes sinks in on the bond market. Well, one should also note that the difference between the nominal bonds and the tips are not an unbiased estimate of that inflation rate, even though it is used by the Fed as a guideline. That's one reason why we call that difference the break-even rate of inflation. We do not call it the expected rate of inflation because it is not. It is downward biased. I won't go into all the technicalities why it is. So you got to be very careful about saying, oh yeah, look at inflation expectations are not showing up into that long bond. A lot of things that go into long bond pricing that are very different than what our inflation expectations are just one of those.
Got it.
Professor,
Okay.
thanks so much for spending the time with us. I really appreciate it. I think we just had one last question for you to close it out.
Sure.
Yeah, I mean, we are bullish on stocks long run, just like you do. But at one point, things will change. What would change your mind about stocks?
Well, I mean, if the Fed went too fast, it would change my mind on stocks. I still think this bull market is on. I do not think it's over. Even today, when I warned about the reaction to the Fed announcement, and I said I called it a taper tremor, not a taper tantrum, as the press calls it. A tremor is a little, and that's exactly sort of what we had, a little tremor here. It's going, one has to realize in owning stocks, the fantastic returns are because you have to go through periods where it does decline and become difficult. And to realize those excellent long-term returns, and I do believe this bull market is going to continue, is going to reach new highs. You have to go through times that are trying, and I fully approve of your stance on equities.
Got it. Yeah. Thanks a lot for being with us today, Professor Siegel. It was we learned a lot from the conversation for sure.
Well, thank you very much.